The U.S. dollar stabilizing after Monday's pullback that came amid heightened political pressure on the Fed Reserve, while the criminal investigation into Powell sparked unease on Wall Street, drawing criticism from former Fed and Treasury officials, as well as outcries from global central bankers. And on the heels of jobs and inflation figures, Fed funds futures show little expectations of a rate cut through the next three Fed meetings. And the U.S. Supreme Court hasn't yet released its decision on Trump's use of emergency tariff powers. Well, joining me to weigh in on the U.S. currency is Elias Haddad, VP and Global Head of Market Strategy of the FX team at BBH. Good morning, good afternoon to you. Thank you so much for joining me. Well, we all know that 2026 is off to quite a bumpy start. The first full trading week of the year, the dollar rose against most majors, supported by Fed rate expectations and data, while this week has been chock full of developments on politics as well as geopolitics. So what is your near-term outlook for the U.S. dollar?
Yeah, good morning, Remy, and thank you very much for having me on your show. Right now, really, what's supporting the U.S. dollar, despite all this uncertainty with or political um, um, interference with the Fed's independence and all these negative news, is the fact that you've got a run of Goldilocks type U.S. data, right? That it's not too hot, not too cold. That suggests that the Fed policy is in the right place for now. And as you pointed out at the opening of your segment, that has led to a bit of re-anchoring in rate expectations in favor of the US dollar. So in the short term, I think that can continue to offer the US dollar some support. But the reason I doubt that the US dollar will make new cyclical highs is because I still think that the Fed will deliver the 50 basis points of rate cuts that is currently priced in by interest rate futures, and for two reasons. You look at the inflation backdrop in the U.S. It has significantly improved. In fact, the upside risks to inflation are fading. Yesterday's PPI data showed that producers are actually absorbing a lot of the cost and not passing it on to the consumer. So that's a downside risk to inflation. You look at the ISM prices paid index, good leading indicator of future prices, and they've been falling. And meanwhile, you got wage growth in the U.S. that's growing essentially in line with the Fed's 2% target, given that productivity growth is around 2%. So to me, the inflation backdrop in the U.S. leaves plenty of room for the Fed to deliver rate cuts later this year, and that's one of the reasons why I think that the dollar is unlikely to make new cyclical highs. The second reason is on the employment front, right? I think that the data, the latest non-farm payrolls was relatively mixed, but downside risks to employment have increased. A lot of the jobs, essentially, actually all the private sector jobs that have been created in December have come from the non-cyclical healthcare and social assistance sector. That's not a sign of a very solid labor market. In fact, in the 3 months to December, I think the U.S. economy lost almost or nearly 20,000 jobs over those 3 months. So that's why I think that the Fed has room to deliver those cuts, and that the US dollar is unlikely to make new cyclical highs.
Okay, well, Elias, we have time for one more question since we're creeping up against the opening bell here at the New York Stock Exchange. So shifting our focus to the major currency pairs, whether we're talking about euro dollar, the British pound against the U.S. currency, or dollar yen, what ranges are you looking at, and what do you think matters most moving into the rest of 2026?
Yeah, that's a great question. Right now, I think euro has pretty good support around the 115 level. Dollar yen probably around 160, a little bit north of that. But generally, I think that 2026 will be defined as a year where fiscal stress is going to become increasingly important, and where fiscal policy or fiscal credibility, I should say, along with rate differentials, are going to be key drivers for the currency market. And I think on those two things, from fiscal and monetary policy, it doesn't bode too well for the US dollar. So I think the dollar has more downside for 2026, especially against the Japanese yen.
Okay, Elias, well, thank you so much for joining me. A lot to keep our eyes on as we head into this year. So I appreciate your time. And as always, thank you so much for all of your insights.
Thank you, Remy.